Good afternoon. An update on the economy, how it fits with our business cycle model. I'm Rich Posse for Critical Point. It's April 23rd. Today, in the recent days here, we've had another round of economic data. Today we got the IHS Market Composite PMI for April, and that's this line. And then the gray bars are actually the US GDP. And what they're showing is the correlation of the PMIs to GDP. It works very, very well. And the PMI, now this is only the flash, so it's not the final result for April, but the flash moved to a record high. And what it means is when the PMI moves above 50, the economy's growing. And the higher it trends above 50, the faster the pace. So if we're at record highs, then this economy is just roaring, okay? And what you can see, the GDP has been a little wilder and crazier than the PMIs, but what it is signaling that we're probably going to get higher GDP in coming months here, okay? It'll be that strong of a correlation still. So a positive report for the economy. Now today on the API news, there was a report of new home sales surged 20.7% in March to 1.02 million homes. Now sometimes home sales numbers can look positive, but they're actually not that positive relative to the overall economy, and then sometimes it is. So you have to be careful how you use it. But right at the moment, it does send a message that yes, people are buying homes. They're optimistic of the future. They want to get going. They have cabin fever. They want to get back to work, get out of the apartment, and enjoy life, invest, spend. And they're probably also looking at interest rates possibly going higher, saying, might as well lock in that interest rate and buy ourselves a home. Okay, so this report is out of the BLS, the Bureau of Labor and Statistics. And it's actually 12-month percentage change of consumer price index, giving us an idea of inflation. And we can see the recent surge of inflation and CPI really comes from energy. But notice food spiked. All items less food and energy spiked. And the end result is all items were up for that recent, 2.4, I can't remember now, 2.7%, 2.6% CPI. So inflation is rallying as we forecast for months now, years now, for the model relative to getting a recession by 2020 to 2021. We got the recession that began and was over in 2020, in my opinion. The rest of the world, however, the recession began in 2018. The U.S. was worried about it. The U.S. saw signs of a recession coming, and then later kind of gave up on that as the Fed kept printing money and trying to help out by late 2019. Then the virus recession came in to slam the U.S. down along with the rest of the world. Now the U.S. and world's all on the same page, and we got a brand new business cycle of when the economy should grow for 7 to 12 years. And the stock market, believe it or not, runs a good correlation to that in terms of duration, time, valuation. The stock market might be out of line. Some of the internal fluctuations of the stock market may seem to have nothing to do with the economy and fundamentals, but at least for that particular business cycle, which is, I think, one of the more important for us to follow in terms of how it impacts our lives, how our jobs, our businesses, our investments, it's actually bullish. And at least we got some more data today to support that thinking. This is another chart of CPI to give you an idea of inflation. And we can see these gray periods are recession, economic recessions. We can see the collapse in inflation. We had a half cycle, our LT2 cycle, bringing inflation back down. That was actually a secondary recession for some regions of the world, and for the U.S., a secondary recession in manufacturing and commodities, but it just didn't spread into the services and the rest of the economy, so it slipped under the radar screen and did not show up as a recession, but it was what I call a secondary recession for the U.S. occurring going into 2015. And it did upset the markets a little bit, and then the markets got nervous over the election and all that. We can see we got the rebound, and what this is LT2, another LT2, and then it combined for an LT3. That's the major long-term business cycle, and it's up, and lo and behold, inflation's up. And you normally want to see inflation rise coming out of a recession. Even if you don't agree with that, let's put it this way, historically that's what it does, okay? And it's normally not as bad as inflation that would come in late in an economic period. In other words, here's an economic boom, and this inflation right in here would normally be considered bad. It was getting late, and things were getting out of hand, out of whack, okay? And then lo and behold, you get a recession and you whack it down to whack it back in line, okay? So at any rate, it looks good here. I think we got a positive result here. Now this week we also had news on raising the capital gains tax. That upset the stock market, and in our model, we decided to go with the idea the market would shrug it off. And as a few minutes ago, the market was taking out yesterday's high, and I think it was looking at the home sales. I think it's looking at the inflation as a positive thing. And I think it was looking at some of these other numbers that I've shown here, specifically the combo PMIs for the U.S. Now, we'll get the official PMIs, combo, service, and manufacturing for the first business day of next month, and it'll be for April. And I suspect it won't be much different than what we've seen today. So I think the stock market just said, yep, let's shrug off this worries over the tax hike. We'll work on that later. And let's focus on the economy's growing. It's growing at a fast pace. And that the fact the Fed's probably not going to step in, at least in the near term, and raise interest rates. The Fed claims it's not going to raise interest rates till next year or even the following year. So the point is we got room to run here when stocks should be able to go higher on the back of a growing economy, and for some people still an opening economy as we shrug off the virus recession. Manage your risk relative analysis of others. Past results are not necessarily indicative of future results. Have a great weekend. I hope this little update will entice you to at least follow us for some free information at criticalpoint.podbean.com. But hopefully you'll also click on some of those videos that are meant for subscribers and click the subscribe button, the buy button, and give us a chance here. And I think you wait just a few months, you'll say, you know what, I'm keeping this. My guess is you're going to be around for years to come, because we got a fantastic bull market and economic growth here in coming years. But there will be a day when I'll say sell, sell, sell. We got a recession, and we might even have a severe bear market. Thank you.